now let's talk about these new tax provisions that are not dealing with the refundable credits. And again, these two come out of the Consolidated Appropriations Act and out of the American Rescue Act. And so the first one that we want to talk about is the premium tax credit. There's been a major change in the premium tax credit. So folks that obtain their health coverage through the Affordable Care Act are, there's going to be a lot of things that are going to be different this year than last year and in prior years. So before the American Rescue Plan was passed, the way the premium tax credit works is that the premium tax credit is a calculation that has always been based on the cost, the monthly cost of what is known as the second lowest price silver plan. And what it is it's based on what the cost is of that plan, and then what the income is, the household income is of the taxpayers that have this health coverage. The contributions that prior to this year, the contribution that the taxpayer was supposed to pay ranged from a low of 2.07% to a high of 9.78% of their household income. And they would pay that towards the cost of the second lowest health plan. This is how it got calculated. It's a confusing calculation, but that's how it's worked. And then if your income was between 100% and 133%, you would be expected to pay at the low end of that 2.07% of your income towards the cost of the second lowest priced silver plan. As your income got higher, once it reached 300% of the federal poverty level, then up till and got to 400%, you then would contribute what was last year, the maximum was 9.78%. And once your income went over 400% of the federal poverty level, your household income went over that, you paid 100% of the cost of your coverage. You got no premium tax subsidy. That's just the way this has worked. This is the way it's worked since 2014. The percentages have changed over the years a little bit, but this is how it's worked ever since 2014 when this came into existence. All right. What is new for 2021 and for 2022? So this will be something that we'll deal with this year, and we will deal with this also next year, is that maximum household income limitation has been eliminated. Previously this meant if you made over 400%, you weren't eligible. Now it means that if your income is over 400% of the federal poverty level, you're still going to be eligible for, depending on how much your income is, you're going to be eligible, you may be eligible for some premium tax credit. So the way it's now going to work is for 2021 and 2022 is the calculation of the credit is still based on that second lowest price silver plan. And it's also based on your household income. However, if your household income is no greater than 150% of the federal poverty level, you will now receive a subsidy of 100% of the cost of the second lowest silver plan. If your income is above 100% up to 400%, you will start to pay a percentage, which ranges from 0 to 8.5% of your household income up until you get to 400%. And so it's a sliding scale. Once your income goes above 400%, you will still be expected to pay no more than 8.5% of your income if you buy the second lowest cost silver plan. All right, let me show you how this is going to work with an example. And this is actually an example that the federal marketplace uses based on their numbers. And here it goes, is that here's an example of a taxpayer whose income is going to exceed 400% of the federal poverty level. And this is a person who's 64 years old. And the premium cost for somebody who's 64 years old in that marketplace for the year is $12,866. And 400% of the federal poverty level for a single person previously would have meant that if this person's income was $1 over 400%, which came out to $51,041, they would pay the entire cost of that health coverage. They would have to pay 100% of that, which equates to over 25% of their income. Going forward in 2021, this same taxpayer is only going to pay 8.5% of their income, which equates to $4,338. So this is a huge change for particularly older Americans that aren't quite on Medicare, because the cost of their health coverage is quite high with respect to, this is going to limit that they will no longer have to pay more than 8.5% of their income for their health coverage. All right. The second thing that is really dramatically different is there's a special rule, but this rule is only for 2021 regarding unemployment. And somebody who receives unemployment in 2021, or if they're eligible to receive unemployment, they will be treated as if their household income is 133% of the federal poverty level. And as I said earlier, a taxpayer whose income is only 133% is going to receive a subsidy of 100% of the cost of the second lowest silver plan. What this means is you could have a taxpayer who makes $100,000 and they also received unemployment, or their spouse received unemployment during the year. We saw that a lot in 2020, where we had a lot of taxpayers with fairly high income, but also had unemployment on the tax return. Anyone who's in that situation will be treated as if their income is at 133% of the federal poverty level, and they will then receive a subsidy amount that is equal to 100% of the second lowest cost silver plan. This is going to be you're going to see some returns where you're going to have taxpayers with fairly high income, but their income will now equate, because there's unemployment on there, they're going to get a large premium tax credit based on this rule that's new for 2021. There is a new question on the form, and there'll be a question that'll have to be answered when you're on in the tax programs, that you can select this. The tax programs are also designed that if unemployment is entered on the tax return, it's automatically going to trigger this. So you will see that on these forms. So you may get some surprising results when you're looking at form on your premium tax credits this year. The next thing is that last year, as part of the Recovery Act, the taxpayers were given a waiver. They did not have to repay any excess premium tax credit. However, that was only for last year. So this year, that provision doesn't exist. So that is something, so they made these enhancements to the premium tax credit, but this one is no longer applicable. So you could have taxpayers who may have to repay this year the premium tax credit, but then last year they did not, because no one had to repay it in 2020.